So let's begin by looking back at some Wall Street analysts' initial predictions for the market performance in 2021 and how stock actually performed in 2021. And also we'll look at some of the factors that drove that performance. So with multiple COVID-19 vaccines that were announced in the latter part of 2020, Wall Street analysts were actually cautiously optimistic about 2021. And while the US wasn't actually out of the woods, at that time, there were a number of reasons to be hopeful of a strong economic recovery, including multiple vaccines to stem the spread of the infections, fiscal support, monetary accommodations, and also a budding reopening. As you can see from the actual results, the market performed better than even the most bullish analysts could have hoped for. For instance, one of the major firms was the most optimistic of the analysts that were on that list, and they're calling for about 20% increase in 2020 closing levels. Even that prediction ended up underestimating where the markets closed in 2021. So let's talk about some of the factors that led to all this. So after a bumpy start to the year due to the slow vaccine rollout and also some political uncertainty, the stock market climbed steadily higher throughout the year with a succession of better than expected quarterly and corporate profit results and a strong rebound in the economic activity. However, the climb was not without hiccups. As we had a rise in the Delta variant infections in the third quarter, we also had accelerated inflation and we had worries about the Fed's tapering plans that led to short-lived pullback in the markets. So in the following images, we'll discuss each factor separately, and we'll do that in a more detailed level. But first, let's look at how those factors affected stock over the course of the year. So as the chart shows, you see a steady move higher throughout 2021, except for some periodic dips. The worst of which was the retreat in September, as concerns were there about the economy and the Fed policy peaked at that time. As you know, the S&P 500 is an unmanaged index that's generally considered representative of the US stock market. Keep in mind that the past performance of these things does not guarantee future results, and individuals cannot invest directly in the index. The return and principal value of the stock prices will fluctuate as market conditions change. So without going through each of these dates, let's look at some of those few noteworthy points. As you could see, the market was choppy during the first quarter of 2021, but take a look at mid-March, where the US crossed the mark of 100 million vaccinated Americans. At that point, the sense was beginning to grow that the nation has overcome the fits and starts in our vaccination rollout. And investors start to begin to feel a little bit more comfortable that the country was finally getting in a place where the economy could sustain its growth momentum. However, keep in mind, there were scares throughout 2021. So look at the middle of July and more broadly, the month of September. The one-day slide in July and nearly 1 month retreat in September were largely attributed to COVID-19 related events. And we saw the stock market resume a climb in October based on the strength of strong corporate earnings, a decline in COVID-19 cases, and the upbeat report from the Fed as well. Also, market did turn volatile in the close of the year, which was slumping in the news of the Omicron variant the day after Thanksgiving and testimony by Fed Chair Powell that he was considering accelerating the bond taper and contemplating more rate hikes sooner than anticipated, of course. And higher inflation and an improving labor market were cited as the reason to justify accelerating the monetary normalization. So the market closed out the year with the Feds announcing some decisive steps on monetary policy that may very likely impact the markets in 2022, which we'll discuss in more details later in the presentation here. So despite the pivot towards a less accommodating monetary policy, stocks climbed higher into the year end as Omicron fears receded a little bit here. You see, corporate earnings are one of the primary determinants of stock prices over the long term. And as this chart indicates, corporate profits came roaring back from their 2020 pandemic levels, which lifted investor sentiment. Also, earnings soared into the second quarter of 2021, posting a 25% year-over-year jump in the corporate profits. However, the third quarter results may have been even a little bit more impressive since the 17% growth in earnings was during the wave of new Delta variant infections. Investors were especially impressed that the spike in infection causes did not diminish consumer demand and that companies were able to maintain their profit margins amid rising inflation and supply chain challenges. The economy experienced a strong rebound in the first half of the year, as evidenced by the successive increase in GDP. However, growth moderated in the third quarter due to the rising COVID-19 infections and growing bottlenecks in the supply chain. So while many observers anticipate a reacceleration of GDP expansion in the fourth quarter, continuing supply chain problems may prove to be a drag. Labor markets were slow to benefit from the economic reopening of the first half, but as you can see, the unemployment rate dropped sharply by the end of the third quarter. And as we entered into the last 3 months of the year, the labor outlook actually continued to improve, with job openings exceeding the number of unemployed and robust wage growth. Inflation did develop as a real concern as the year progressed, rising from a modest 2.6% in March to 5.4% in September, with October and November 12 months inflation rates setting an even higher bar. So we'll examine this development a bit more in depth a little bit later. Also, consumer sentiment was in an upward trajectory as Americans' consumers felt even better about economic reopening and safer when the rollout of an effective vaccine occurred. However, it flagged amid a surge in Delta variant infections at the start of the second half of the year. The fourth quarter number is the actual sentiment reading for November and reflects continued downward slope in consumer outlook due to rising inflation and the perception that policies have not been put in place so to arrest the rise in prices. Finally, home builders' optimism was especially high in 2021. Not surprising given the low interest rate environment and the continued consumer demand for homes amid the pandemic. The number indicated is a survey of a single-family home builders, their view of the current conditions, and their 6-month outlook. Scoring on the basis of 0 to 100, you could see how high their optimism was throughout the year, notwithstanding a dip in the third quarter owing to that quarter's resurgence of COVID-19 cases. So we did look at some of the factors affecting market performance in 2021. Next, we'll look at where we are now, and we'll examine some of the headwinds and tailwinds as well that could affect the direction of the economic growth and financial markets in 2022. And to create some context about where we stand today on various factors, let's start by examining where we stood before the pandemic began. After a stretch of good earning performance, conditions in February 2020 were mixed, though still positive. You can see a number of positive indicators, including monetary policy, consumer spending, interest rates, and perhaps most notably, inflation and energy. There were some cautionary signs about the future, such as the economic outlook, equity valuations, leading economic indices, and corporate profit growth. The only two factors of concern were geopolitical risk and the domestic political environment at that time. Now let's fast forward to November 2020. By then, we appeared to be beyond the worst days of the economic lockdown and COVID-19 cases. The overall outlook was cautious. While monetary policy, inflation, corporate profit growth, and leading economic indices were trending positive, there were more cautionary signals, most significantly in consumer spending, energy costs, business sentiment, and labor market weakness. There was also double number of negative indicators from February, most notably equity valuations and disposable personal income. Now let's review what these financial and economic indicators tell us about today's current state. As you could see, 17 of 20 indicators are green, which suggests that the economy and the markets are in good position in 2022. Only 3 are flashing some warning signals, such as equity market valuations. After the run-up in values in 2021, this shouldn't come to you as too much of a surprise. There are no outright negative indicators here. So let's delve a little bit deeper into one of those speedometers, the leading economic index, also known as LEI. This includes 10 components ranging from stock prices to manufacturing orders. When examined together, this data may give clearer view of where we are. Leading economic indicators suggest that economic expansion is trending higher into 2022, though supply chain bottlenecks cannot be overlooked as a factor that may frustrate this particular outlook. As you could see, a rise in the index leading economic indicators has never been followed by a recession. So that's encouraging. However, no model is flawless, especially with COVID-19 still hanging over global economies. It's important to remind all of you that past performance does not guarantee future results. But as we review charts like these, history can suggest where we are in the economic cycle. It's also important to remember that forecasts are based on assumptions and subject to revisions over time. Financial, economic, political, and regulatory issues may cause the actual results to differ from the expectations as you see them expressed here. From the leading economic indicators and the economic speedometers, we just saw that the economic outlook is looking positive for 2022. However, the economy and the financial markets will have to withstand some potential headwinds to meet these optimistic expectations. The first headwind may be the emergence of Omicron, the latest variant of the COVID-19 virus, along with the resurgence of the Delta variant. While few expect the sort of economic shutdown that accompanied the 2020 pandemic, given the progress of vaccinations, any moves to restrict social contact may adversely impact economic growth, similar to the Delta variant surge last year. Inflation, by the way, does remain a big challenge for the economy, as higher prices may sap consumer spending power and consumer confidence as well. We will take a deeper dive into the inflation implication for the markets later in the presentation, however. another point, there's a potential for us to see rising yields as bond investors look for higher yields to compensate for rising costs. At the end of last year, the Fed announced that it will be quickening the pace of its wind down of the monthly bond purchase and signaled that as many as 3 rate hikes might follow in 2022. The Fed policies have been a major factor in driving stock prices higher. However, the Fed is looking to return to more normalized monetary policy, sort of a healthy economy, and also a rebounding labor market and accelerating inflation. It is uncertain how investors will react once support are removed and interest rates move higher. We saw an example of this in the beginning of the year. Think back to January, when the minutes from the Fed's December FOMC meeting indicated that a rate hike might come out sooner than expected, which led to a sharp sell-off at that time. One result of higher rates may be revaluation of stock prices so to reflect the higher interest rates. However, if the Fed finds itself behind the curve in fighting inflation, it may be forced to use monetary brakes, which could adversely impact markets. As 2021 comes to a close, there were early indications of slowing economic growth in China, in large part due to zero COVID-19 policy that shut down whole cities at the first report of an infection. As its wealth has grown, China has become increasingly larger importer of foreign consumer goods and raw materials, of course. Any reduction in demand will be a drag on a wide range of companies globally. The midterm elections also create a degree of uncertainty. The markets will be looking to see if there's a shift in congressional power and what that may mean for future economic policies. Finally, geopolitical tensions are always a political headwind. Tensions in countries bordering Russia, China's threat towards Taiwan, and Russia's leverage over Europe's energy supply are just one of the examples of where tensions may flare. So the economy is expected to expand in 2022. The level of which economic growth serves to propel markets higher, of course, will be a function of how healthy that growth is. Though the Fed is reducing its monthly bond purchases, they are not expected to end until June or July. Moreover, the Fed has indicated that any rate hikes will likely be in the year's second half. The takeaway here is that monetary policy remains quite accommodative, despite these early steps towards normalization. Corporate profits were solid in 2021. As I mentioned earlier, one of the primary determinants of stock prices over the long term is corporate earnings, provided that earnings continue to expand in 2022. This may justify current valuations and serve as a catalyst for higher prices. Of course, past performance does not guarantee future results, and the return and principal value of stock prices will fluctuate as market conditions change. Also, the consumer appears to be healthy as net worth has grown from pre-pandemic levels. Financially strong consumers should continue to support further consumer demand for goods and services. That said, there is one important caveat to this particular tailwind. Consumer confidence is actually at a cycle owing to the sharp and continued rise of inflation. Watching the cost of basic consumer goods like food and energy take up an increasing amount of personal budget and is not only psychologically dispiriting, but it could reduce the amount of discretionary income consumers have at their disposal. There is another side to what inflation may do to consumer spending. Inflation may increase spending in the short term, since behavioral experience suggests that consumers frequently choose to buy today if they believe prices will be higher tomorrow. So despite this kernel of uncertainty regarding the consumer, we expect that consumers will be net positive force for propelling economic expansion. So before we move into discussions of 2022 forecast, let's examine this chart to see where stock prices are trending against historical averages. The most common way to do this is to look at PE, or price to earning ratio, which measures what investors are willing to pay for a company earnings. If you look at the dotted line in the middle, you'll see that the PE for the last 25 years is 16.8. You can also see that the PE moves quite a bit with a peak during the dot-com boom and a trough during the credit crisis. As of October 2021, the PE was 21.40, which is higher than its 25-year average. It may bear mentioning that the big technology stocks, which because of their growth prospects typically sport higher PE ratios and represent a greater proportion of the S&P 500 than ever. So a comparison to the past may have actual limited value. These higher valuation may also be in line considering the current low interest rate environment. So in my opinion, when it comes to the market, there's superior and inferior. So inferior, in my opinion, is timing the markets, trying to capture the highs, avoid the lows, trying to navigate that sea. In my opinion, superior is a plan. But even more superior, in my opinion, than just a plan is a holistic plan. A holistic plan where everything in your situation is considered carefully. And the entire plan is designed in such a way that takes into account every detail of the things that concern you. So what can we conclude from this whole presentation and information that we gave you here? Is that it can try to predict, and we can all try to predict what's going to happen next. But ultimately, no one really knows. You could not have predicted COVID-19 if you wanted to. And you could not have predicted all the things that have happened in the past 2 years if you wanted to. If we were talking here about 5 years ago, or 2 years ago, 3 years ago, before it actually happened. So the solution to all that is the creation, in my opinion, of a great plan, a holistic plan that takes into consideration such possibility of such events. So if you haven't done that, or you've done that, but you're not sure if it's a really, really good solid plan, I suggest you have a conversation with one of our team members to help you understand what situations you're in and what could be possibly a detriment or could possibly be an issue. We do run stress tests on portfolios, and we do help people with the creation of holistic plans that can help them achieve their goals with mitigation of risk at the same time. The phone number to contact is 310-820-4411. Feel free to reach out. And by the way, if you even have a question, feel free to reach out to ask a question, and we'll see if we can help you in any way we can. Thanks again, and we'll see you around.